All right, so we are getting towards the tail end of earnings season. There is still a handful of companies I wanted to bring up. First things first, let's talk about the market briefly. The market continues to pull back. We actually did have a green candle to close the week, but again, we are just above the 50-day moving average for the S&P, just barely though, just barely. So we're right about at that 50-day moving average. It's been a while since we went below that, and I mean, if you look back, basically since it hasn't been since April that we've actually pulled back further than the 50-day. Actually, it's been March. Sorry, since we pulled back further than the 50-day, right? So it's been roughly 6 months since we've pulled back below the 50-day. If we look at in late April, early May, late May, we've pulled back to roughly the 50-day. So again, it's going to be interesting to see exactly how far we pull back. Again, I've said for quite a while now we're going to see a pullback. Again, how much is it going to be? Nobody knows. Are we going to going into recession? I think that's unlikely, but the most likely scenario looks like it'll be fairly mild. But again, nobody knows. The yield curves seem to point to, okay, it could be late this year, early next year. The markets seem to be predicting that rates will be cut early to mid next year. Again, nobody knows. The one thing that if you go back a year or even 6, 7, 8 months, most people were saying, yeah, we're going to be in recession right now. A lot of people were even saying, yeah, rates are going to be cut by now. And that's not going to be happening anytime soon. If anything, we're going to be getting even higher rates still yet. So that's something to keep an eye on. But again, nobody knows what's going to happen for sure. My prediction is we probably chop sideways for a little while, and then the market will decide, hey, do I want to go down further, or do I want to go higher by the end of the year or early next year? But my guess is we chop sideways for a little bit. We probably stay within a 5 to 10% range, and then we get a clear signal. That's my prediction. If we look at the QQQs, the NASDAQ, again, these are actually a little bit below the 50-day, right? That's a little bit below. But I mean, if you look at that, that's also served as support for the QQQs basically since February, right? It's stayed above that since February. So again, it's going to be interesting to see exactly where that goes as well. The one other prediction that I would make is that I think we're going to see a little bit of a counter trend rally. A lot of the tech, or growthier names have done very, very well this year. And I think we'll see a little bit of a counter trend rally, and that the tech names or the big growthy names won't do quite as good for the last half of the year, and the value names will do better. And again, another trend that's emerged recently is energy has started to do very good. Again, that will depend on recession. Again, if we overt a recession, I think we could see energy hit, the levels that they were in, like, this late 2022 and into 2022. I think we could easily see oil go back to 100, 110, or even 120, maybe even push all-time highs. You never know. But that's something that OPEC and whatnot have been very clear on, that they're not going to let oil prices go down significantly. So that's another thing to keep an eye on. But again, if you look at over the last month, as far as the oil market goes, they're up like a solid a little over 10%. So that's pretty exciting to see if you are invested in oil. I do have a small position in quite a few different oil companies. If we get into earnings here, let's get into earnings. So if we get into earnings here, the first company, Palantir, their earnings were right on. The revenue was actually up a little bit, although the stock did sell off pretty hard over the last week. If we go back to the last week here, you can see it's down about 12%, which is quite a bit over a week, right? And the big problem with Palantir is, they're not making any money for starters, and number two, this is a company that is diluting massively. They're growing very, very quickly, but again, until this company can produce some solid profits, like, I don't know why anyone would want to be investing in this company. And again, their shares are increasing 9% a year. To me, that's just crazy, and I don't know why anyone would want to invest in a company like that, because again, companies like this are largely driven by hype, And again, that's not something that I would recommend or be a fan of. It just makes no sense to me. The next one, UPS, they missed revenue. They were down a decent amount because of that. I think that they're a solid company. Again, I don't have a position, but I like to follow them because in a lot of ways they're a good gauge on how good the economy is doing. Because again, if people are buying a lot of stuff, well, it's going to be companies like UPS that are moving it around, right? So that's why I like following them. But again, not the greatest of news given they missed revenue, and again, stock was down quite a bit, or for them at least quite a bit because of that. Their growth is really in trouble right now. If you look at their valuation, it's actually not terrible. But again, a price of free cash flow of 25, I still think is a little more than I would like to pay. Again, just my personal opinion, but that is UPS. The next one is Medical Properties Trust. Again, this is a popular dividend stock because it has a crazy high dividend. But this is also a company that's got absolutely destroyed over the last year or so. Again, 14% dividend. A lot of people are probably looking at that like, hey, this is just this amazing dividend. You know, why aren't more people taking advantage of this? Well, I mean, if you look at it, if we go back a year, this is a company that was let's just go back even to see its all-time high. Again, this was at one point a 23 and almost a $24 stock, right? And if we go back to where it is now, it's down 63%, right? In roughly, a year and a half, it's down 63%, right? And again, they've had issues with tenants. They've had a lot of different issues. The higher rates, I think, are hurting them as well. But again, in my opinion, this is an example of a dividend trap, right? There's a lot of people that fall for this and that they see these high dividends and they think, hey, I'm going to get this crazy good return. Even if the share price doesn't do anything, I'm still going to get this great return, when the reality is that you're not, at least most likely, right? I mean, if you look at their payout ratio, it's dangerously high. This company's also underperformed the S&P by a lot over the last 10 years. Again, to me, this is just a clear red flag, in almost every way. They've increased their dividend, actually not that bad over time, right? They're up, I guess, 3% a year. But again, for a company that has this high of a dividend, right, they're not going to be able to maintain that, right? No way this is going to be able to be maintained. They're either going to have to take on debt or cut that dividend, right? So again, in my opinion, this is an example of a company you want to avoid, right? The next one is Manulife. This is a company I do have a small position in that, again, you're not going to get crazy returns on. But again, there's a handful of reasons I like it. Number one, they did beat earnings, which is nice to see. But the main reason is the dividend, right? And if we look at the dividend here, let's look at the dividend. So the current dividend is 5.5%. They're growing at 10% a year. And the payout ratio is only 50% or 49%, right? So they could be paying a 11% dividend right now, and that's something that people don't really seem to want to catch on to. Again, the company has underperformed the S&P by a lot, but again, I mean, if we go, let's go back maybe 5 years. Let's see what it's at here. It's not actually that much worse, right? And again, one of the main reasons that people are bearish on this company is they're just bearish on the sector, and considering how hard the company got hit in 2008, I think that's one of the other big reasons as well. But again, the fundamentals in this company are actually not that bad. And again, to get a 5% dividend that is fairly easy to maintain, and not only that's going to go up over time, to me, it is worth a small position, I guess is the best way of putting it. The next one, another company I do have a small position in, Canadian Natural Resources. They beat earnings, which is actually good to see, especially for an oil and gas company. Again, they have a solid dividend as well. If we look at that dividend here, 4.33%. And again, they're actually growing it very, very nicely, right? They're growing it very nicely. Are they going to be able to continue growing it that nicely? No, but I think they're still going to be able to grow that. Again, if we look at the payout ratio here, again, 51%. So they do have room to continue to grow that. I think it's a good sector to be in. Like I say, the energy sector over the next 10 years, I still think is going to do well. If you can get these troughs where oil goes down to 70, even in the 60s, I think that's a perfect time to buy companies like this, because that's pretty much a artificial floor on oil and gas prices, because you have OPEC committed to they'll just cut production, right? Or also you have a lot of these other countries that will start stockpiling, right? So oil, I think, is a great buy right around, if it goes into the low 70s or 60s, in my opinion, it's a good buy. The last company I wanted to talk about here is Lucid. Again, don't have a position for should be obvious reasons. Again, they missed earnings. The company actually was up, I believe, on the week. Let's double check and see here. Yes, they were actually up on the week somehow. Again, this is a $15 billion company that loses money. In my opinion, it's kind of the epitome of a company you want to avoid, because again, they're losing money. I mean, let's go back a year here. How much is this company down? I mean, let's actually go back to its peak, just out of curiosity here. I mean, if we go back to its peak, it is down like 86%, which is just crazy, right? I mean, and again, people need to realize, when you're looking at companies like this that are losing money, that are taking on debt or issuing shares to stay afloat, like, again, this has almost every red flag in the book, in my opinion, right? I mean, they're massively unprofitable. They're not even really growing. Like this, the management's not doing a great job. Like, everything, damn near everything, is a red flag here. And again, people still buy companies like this. And again, it's not that people say, oh, I know a guy who made money on a company like that, or made like whatever. It's like, chances are you're going to lose money on a company like this. Chances are you're going to get killed, right? Again, just my opinion. Everything here, just my opinion. Do your own due diligence. But again, in my opinion, companies like this are massive red flags, because again, they're losing money, they're issuing shares, they're taking on debt. Every red flag you can pretty much imagine is companies like this. So anyway, that's what I wanted to talk about today. If you liked the video, hit that like and subscribe. Feel free to comment, all that good stuff, and stay tuned for more.